Inconsistent or poor investment strategy. How to develop a solid plan for success. Are you struggling to see consistent returns on your investments? It might be because you don't have a clear strategy in place. In today's video, I'll show you how to develop a solid investment plan that aligns with your goals and risk tolerance to ensure steady progress. When it comes to investing, many young professionals find themselves struggling with uncertainty and inconsistency. A lack of strategy, emotional decisions, and failure to plan can often lead to poor results and missed opportunities. This video is designed to turn those challenges into opportunities by addressing the core issues behind shaky investment strategies and by helping you develop a solid action plan for success. If you're ready to take control of your financial future, let's dive in. Investing can feel overwhelming, especially when outcomes don't align with your expectations. One common reason is the absence of a clear and consistent investment plan. Without direction, it's easy to make decisions based on emotion, such as fear during market dips or greed during speculative booms. Another underlying issue is neglecting proper research and analysis. For example, blindly following trends or basing investments on hearsay often results in mismatched strategies and regrets later on. Finally, many young professionals fail to align their investments with their goals. Instead of tailoring portfolios to personal milestones like buying a home or retirement, they might pour money into high-risk ventures with no connection to their actual needs. Recognizing these patterns is the first step toward building a better approach. To overcome inconsistency, it's essential to adopt a strategic mindset rooted in long-term thinking. Successful investing isn't about quick wins. It's about setting realistic goals, being patient, and making informed decisions. First, define what you want your investments to achieve. Are you saving for a future home, planning to retire early, or simply building wealth over time? Identifying these goals will give your strategy direction. Another critical factor is understanding your risk tolerance. Some people are comfortable with high risk for potentially higher returns, while others prefer low-risk investments. Knowing this about yourself can help you choose options that align with both your comfort level and objectives. With your goals and risk tolerance clear, it's time to craft a reliable investment plan. Start by categorizing your goals into short-term, medium-term, and long-term objectives. For example, saving for a vacation might be a short-term goal, while building a retirement nest egg is a long-term commitment. Put your plan in writing. Document your financial goals, the strategies you plan to use to achieve them, and timelines for each. Writing down your plan increases accountability and serves as a reference for staying on track. Next, utilize tools and resources to make planning more manageable. Budgeting apps and financial tools can help you set aside funds regularly and monitor your contributions. A good plan isn't static, it's adaptable to change, so don't hesitate to revise it as your circumstances evolve. Every solid strategy is built on foundational principles. Diversification should be one of the cornerstones of your plan. This means spreading your investments across various asset classes, such as stocks, bonds, and mutual funds, rather than putting all your money into one. Another principle is harnessing the power of compounding. Compounding refers to the snowball effect where your investments grow, not just from the original amount, but also from the returns they've already generated. The earlier you start, the more time compounding has to work its magic. Consistency plays a significant role in successful investing. Making small, regular contributions to your portfolio, even during uncertain market conditions, will have a bigger impact over time than irregular large amounts. Think of it as planting seeds for a future financial harvest. Discipline is what separates average investors from effective ones. One of the best ways to build it is by automating your contributions. Set up recurring transfers to your savings or investment accounts to ensure that you're investing regularly without having to think about it. Next, commit to periodic reviews of your portfolio. For example, checking your progress quarterly or annually helps you stay aligned with your goals while avoiding overreaction to short-term market fluctuations. A review doesn't mean changing your strategy impulsively, but rather ensuring that your plan is still on track. Speaking of impulsiveness, it's critical to avoid decisions driven by emotions. Markets are naturally volatile, but reacting to every dip or spike can lead to bad outcomes. Instead, focus on the bigger picture and remember that markets tend to balance out over time. Some of the most successful investors have achieved their goals not through luck, but through disciplined strategies. For instance, legendary investors like Warren Buffett emphasize the importance of staying patient and focusing on long-term value rather than chasing trends. Real-world examples like his offer lessons applicable to anyone, showing that perseverance often trumps flashy but risky decisions. Take this opportunity to learn from their principles. Value investing, seeking undervalued stocks or assets that can deliver solid returns over time, aligns closely with the idea of building stamina rather than sprinting toward financial goals. An effective investment journey is supported by reliable tools and resources. Start by educating yourself through financial literacy resources like beginner-friendly books, podcasts, and online courses. Knowledge empowers you to make confident choices rather than relying on unreliable advice. It's also crucial to understand the basic instruments of investing. Diversify your portfolio with stocks, bonds, ETFs, and index funds, each serving a specific role in mitigating risk and achieving growth. Financial platforms and market research tools can further aid your understanding, making it easier to evaluate where to put your money. Investing isn't a one-and-done activity. It requires regular adjustments. Life circumstances will inevitably change, whether it's increased income, unexpected expenses, or achieving one of your financial goals. When such milestones occur, reassess your investment strategy to stay aligned with your priorities. Your risk exposure should also adapt as you age. Younger investors with time on their side can afford higher risk, but the closer you are to retirement or bigger milestones, the more conservative your portfolio might need to be. Investing doesn't have to be daunting or unpredictable. By understanding common pitfalls and shifting to a clear, actionable strategy, you can replace uncertainty with confidence. A consistent approach that includes diversification, compounding, and disciplined contributions will set you apart as an investor who thinks long-term. Start small, stay committed, and embrace the process of learning from your decisions. Whether you dream of financial independence, early retirement, or simply being in control of your finances, you now have the tools to create a strategy that works for you. Take the first step today. Write down your goals, explore your options, and begin building the habits that will carry you toward financial success. Your journey starts now. Let's make it count. Developing a solid investment strategy is key to achieving consistent and successful results. By setting clear goals, understanding your risk tolerance, diversifying, and sticking to your plan, you'll set yourself up for long-term success. If you found this video helpful, please like, subscribe, and leave a comment with your investment goals or strategies. I'd love to hear from you. Until next time, stay disciplined and invest wisely.